I think I want to appreciate the author for a nice job done. I just heard him mention that this paper has gone through a series of presentations, and I know he has burned some midnight oil to bring it to this level. I would say that I really was attracted to the topic that this study is focused on. And so having said that, my role and my understanding is that I should be able to give commentary that will take this paper to the next level. So I think I would, and this is not organized in any structured way, so I'll just run through the sections and highlight some areas that I found need much more improvement to refine this work. Now, I think the introduction is well done. Although in my view, the author will need to shorten the section and bring the objective closer. Because when you read through the paper, you actually get to page 5, from page 1, for you to understand what the objective of the study actually is. And I think page 5 is too fine to the study. A good study would have a very brief, a very precise background to the problem, and then we state the problem in a very precise way, and then I think on the third page or second page, you have the objectives very clear. But I think we have a lot of write-up, and to me, a lot of it may need to maybe be shifted to the literature review if it is possible. But what I like most about the section is actually figure 1 on banking sector and the real economy, which tries to give us a spice of some data there. And then we use some graphs to try and demonstrate the trends and see exactly where the problem is. So I see it trying to motivate the study quite well. My only confusion is that the topic is focused on East Africa. But this figure is actually using Kenyan data. So I think we can refine that. If I could have a figure here which reflects the East African region, I think it would add some value to the discussion, because this figure helped me motivate the problem. And we cannot use Kenya to motivate East Africa, because we have a whole 5 countries in this. And then I think in the figure, we'll try, because as it is, we have some variables there which were not clearly defined. So, Prof, I think you may have to help us understand. You use some abbreviations which not every reader would understand very easily. We don't know the units in which the variables have been measured. So we will need to know what is this UNMPT? What is this HHCON? You didn't define that. You didn't tell us exactly what it is and how it is measured in terms of the units. So that when we look at that graph, then we can start understanding what those trends are telling us. Now, I heard you mention that you got a comment before regarding the use of flow and stock variables. I think it will still help you because even the current one does not fully address that. I got a bit curious about the relationship between what you are calling the household consumption and GDP growth. For a fact, household consumption is usually the biggest component of GDP. In fact, For a long time, it has occupied around from around 70 to 80% of GDP, private consumption. Then the other things occupy the rest. So one would expect that private consumption would actually mimic very closely movements in GDP, but we note that there's actually almost a whole discrepancy there. Yeah, and then I noted that, of course, on the same figure, you didn't label the units on the left-hand side, which I think we may have to do to make it very clear. Now, I saw some content in the same introduction section, which I didn't see it carried through, because when I was getting to the end of that section, we actually asked two questions. The first one, we asked the question, what is the relationship between household welfare and banking sector performance? And we also asked a question, through which channels does banking sector performance affect household welfare? But these questions are not taken through through the discussion, because I think when I got to the other sections, I noted they dropped somewhere. So I don't know whether this was, these two questions were still carried through the study, or you dropped them at some point. Because in the figure I've just talked about, you deal with issues to do with unemployment, household consumption, and so forth. So I don't know whether that interest was dropped or it was carried through the different, the other sections of the study. Again, when you are trying to motivate why we need to understand the interface between banking sector performance and productivity of real sectors, you actually use sub-Saharan Africa. You actually say that understanding the linkages between the bank performance and productivity is critical for South African region. This is actually when you are just about to tell us exactly your objectives. So my question there was, if we are finding it very critical for Africa, so why are we focusing on East Africa? And then when I get inside some sections, I see now we focus on Kenya. So I think you may have to, so these are just concerns about focus. Let's be consistent about focus. Is it Africa we are interested in? Is it East Africa, as the topic says, where our interest is? Or is it Kenya, where our interest is? So I think I've dealt with that. Now, the next section on the conceptual, on the literature review, this is well done. I think it is well written. I think the author reviewed quite important literature on the subject. But because the author is interested in a relationship between two concepts, and then we are also dealing with channels through which that happens, I thought it will be good to concretize that discussion in some sort of diagram that helps us trace those linkages as they come out in the study. So I think I would really appreciate if we would have some kind of conceptual framework that helps us understand that. Now then, I think the next section is on empirical procedures and results. Now this section, I think my main comment is on table 1 on data, where we have the summary statistics. Again, a comment about the units in which our variables are measured. It cuts across. We don't indicate anywhere those units. But when you get to the interpretation of some of these summary statistics, then I start seeing some of the some of the units being in US dollars, and then there is some exponent, and then into brackets. Then it makes my life difficult. Because what is in the table now is computed again in the text, and I think maybe Prof will have to work on that. These conversions, I think they need to be converted so that when we read that table, what we're interpreting is exactly what is in the table. So I couldn't really understand what some of these numbers mean in terms of that kind of interpretation. So you need to look at the manufacturing value added, services value added, agricultural value added, then HDI, which is the Human Development Index. Yeah, you just tell us how it is. It runs from this to that. And so when we see this, we know what it means, regulatory quality, and so forth. Yeah, so I think some of the specific, whatever to do that, I think I'll provide them in my written comments. Now, there are again some correlations on table 2, and I think I have some disagreement with the interpretation of that table, because I think there is an observation there that it's only some of the metrics which are measuring banking sector performance that portray high correlations, but the other variables do not. I do not agree, because we have many of those variables which have some high correlations, and I think I will highlight those, unless if maybe the results have changed with the revisions of this one. Now, section 3.2 is on the estimating equation, and the author chooses to specify a fixed effect model, of course, with a lagged dependent variable as part of that model. And so, of course, I know the author has tried to justify why we use this, but I think when we have panel data, usually we get interested about the dynamic form of that model when we want to test the persistence of our dependent variable. And that should come from either the conceptual framework, or if we have a theoretical framework, that we are interested about this variable being persistent over time. So here on the specification, I have my first observation is that the specification does not actually strictly accommodate the fixed effects and also the time effects, although they are mentioned in the results, but I think the form that we have in equation 1 does not pick that, and I think the author can work on that. And that too, I think usually when we are confronted with panel data, and the starting point is to think about, of course, an alternative between whether we want to use the fixed effects or the random effects model. And there are ways that, there are tests that are done that help us settle either for a random effects specification or a fixed effects specification. So in this case, I think I lack that argument, because I think there is a Haussmann test that tells us whether we go random effects or fixed effects. But also that if we choose to have dynamic effects, then this will take us into a dynamic specification, I think, which then has very specific ways of being estimated. Now, I think moving into some of the results we have, I think we have the dependent variable is actually a change, which is a form of percentage. But then the right-hand variables that we are interested in, many of them are, because I see we have many of the measures of bank performance are also rates. Yeah, so the interpretation we have for, especially when we are interpreting the change in the independent variable leading to a change in the dependent variable, I think some of those numbers may need to be looked at, because I was just looking at this first one where we are saying a 1% change, a 1% in the return of average bank assets elicits a 5.2% reduction in sectoral value added per capita. If you look at the 5.2% of our value added per capita, is a relatively high number. And the next one is actually 10%, and the other one is 9%. So if 1% alone causes 10%, is a relatively a high magnitude. And I think there could be a problem in the computation of these percentages, which I think the author may want to look at that. And this applies across the other numbers, but I think I'll highlight the areas where I think I had a problem with. Now, in terms of table 3, I think my main question on this table would be, especially when your R squared is too low, close to 0.1, what implication does that have? So I don't know, but I think maybe the author may want to point at that. Now, we then have, I think there is a Kenyan story which is somewhere. Yeah, we have the Kenyan variable there, which was meant to elicit discussions around our situation in Kenya. I think when we discuss this, it is pushed, I think, too far into the end of the section, but I think it will come nicely under the table, under every table that we are discussing. And in some of those cases, we find we actually find some significant relationships, which I think will be good to come out. Now, so table 5 has also the same comment I had about the R squared. I think in winding up, in the equations that, especially for section 3.3 on the transmissions, I think it will be good to have some more detail on how we estimate the Z hat. I think there is a Z hat that we estimate there and then plug into the equation. It is still a black box, I think, at the level at which we are. And then I think the version I had made some comments on the conclusions, I've seen, I think the conclusions have improved a bit. But I think I had also a concern about the implications, because I think the conclusions we had did not have implications for policy, implications for Kenya's banking sector or the regional banking sector, and also implications for maybe the academia, because they would want to, they will find these findings for this study useful. So thank you, and thank you for the good work, Prof.